Hey guys, Sheila here from Mediavandals. In today's video, we are talking about profit. And now, profit is that dirty word that starts with a P that no one likes to talk about because I don't know what it is about business owners, but we don't like to talk about money. Now, the thing about profit is you cannot have a sustainable business without profit. Profit is the lifeblood of every business. The reality is without profit, you cannot thrive and grow. Now, we are taught from high school to college and by our accountants and by anyone in finance that there is a simple formula to profit, and that is sales minus expenses equals profit. Now in this video, I'm going to show you a quick little flip to that formula and a new mindset to think about when dealing with the revenue that your business makes that will quickly drive up your profit and allow you to finally take a paycheck and transform your business from a plateau to a successful, thriving business that grows. So stick around because when we come back, I'm going to show you that simple formula. Okay, so let's jump over to the board behind me, and I am going to take you through the formula that most accountants use to show you if you are profitable or not, and then I'm going to show you a small little hack that you can make to that formula in order to start being profitable right away. Now, once I show you that formula, I'm also going to show you a few ways to split up your funds to help you get to a more profitable state faster and to start making a better paycheck for yourself. So let's jump over and get started. So in this video, we are teaching you how to run a successful, profitable, sustainable business. Now, in traditional accounting, the formula is sales minus expenses equals profit. While this is the way traditional accountants do it, what if we were to reframe something with this? What if we were to make one small change? What would that do to your business? So Mike Michalowicz, the author of a book called Profit First, proposes that if we got rid of this completely and reframed the way we looked at accounting, we would create profitable, sustainable businesses. So let's cross this off and let's reframe this formula. So instead of sales minus expenses equals profit, and the way that works is the majority of business owners will look at their sales. They may, let's use an example of $100,000 in a year. If a company makes $100,000 in a year and they have $60,000 in expenses, so 100, this is 100 minus 60K in expenses, then for the year they have made $40,000 in profit. Now this is not a sustainable way to run a business, and the reason why this is not a sustainable way to run a business, let's use COVID as a perfect example. Businesses that were 30, 40, 50, hell, even 100 years old went down the drain because they were living sales, take away expenses equals profit. They had nothing banked to get them through what we just went through for the last 8 months. By moving profit and expenses, by reframing this, you would have the money banked to sustain you in 6 to 8 months of no business. You should have the money to sustain you in 6 to 8 months of no business, and that is what we're showing here. So by simply swapping those two, so if you have $100,000 a year and you want $50,000 in profit, then you know that your business cannot spend more than $50,000 in expenses. Now, you're probably looking at that going, well, if I had $100,000 a year and I wanted to make 50K in profit, but my expenses were more than 50K, then this doesn't work. Now, this is where this formula comes in. If you have more than $50,000 a year in expenses, let's say you have $60,000 a year in expenses. You do not take $10,000 out of profit and put it towards the 60K in expenses. What you do is you look at these expenses and you say, I am spending too much money. Where can I find $10,000 in savings? The way we get to profit is to make sure that we are not overspending on expenses. Now, Parkinson's law states that work will expand to fill up the time that is allocated to it. So if you give yourself 2 weeks to get a project done, it will take you the entire 2 weeks to get a project done. If you reduce that time and say, I have 1 week to get a 2-week project done, you will find a way to do that project in 1 week. Parkinson's law says that work expands to fill the time allocated to get that work done. And this also translates into business expenses. If you allocate $50,000 towards your expenses, you will look at your budget and decide what to keep and what to get rid of in order to fill that $50,000. If you look at your expenses and decide that you need $100,000 to run your business, you will find a way to spend $100,000. By reframing sales minus expenses equals profit into sales minus profit equals expenses, you will reframe the way you think about spending money on expenses. So how do we do this? How do we decide what profit we want? How do we decide what the expenses are? How do we decide what revenue that we want to make? How do we decide how to get our money to pay ourselves? So there is a target allocation percentage spreadsheet that tells us what these numbers should be. And I'm going to put it on the screen right now. In order to make this formula work, you're going to need 5 bank accounts. Now, whether those 5 bank accounts are a few business accounts and a few personal accounts, or a few President Choice accounts, which are virtual and there's no real cost to them as long as they're sitting online. This is something that you need to figure out how you want to allocate it, but you should be running 5 accounts. 3 of them will be savings accounts and 2 of them will be checkings accounts. The reason why we want 5 accounts is because twice a month, we'll say on the 10th and on the 25th, or if you have a bookkeeper come in, then once a month on whatever day the bookkeeper comes in, you are going to look at all of the revenue that has come in, all of the revenue that has been generated, and you are going to split it up among these 5 accounts. So the way you are going to split these accounts up is you are going to have money in, which is every dollar that comes in every time a client pays you, every check, every credit card payment will come into this account. And this is a checking account. And the reason why it's a checking account is so that you can transfer money in and out without paying huge penalties. The next account we're going to create is our tax account. And this is the 13% sales tax that we pay, plus whatever tax you have to pay as a business. So if you were incorporated, if this is 5% or 10% or whatever, we will also add that. And this is a savings account because we do not touch this money until it is time to pay the government. So we know right off the bat, let's say you pay 5% in business tax plus HST, We knew right off the bat that this account needs to put in 18% of every dollar that comes in into this tax account. Now your next account is your owner's pay account, and this is also a savings account. You will have a profit account, and again, this is a savings account. And then the final account that you are going to create is your operational expenses. And this is a checking account. And the OpEx account is where you will handle all of the expenses that you have, your employees' paychecks, your rent, your lease, your insurance, anything that is required to run your business comes out of your OpEx account. Now, once we have these accounts set up, again, take a look at the target allocation percentages. This spreadsheet that I put on the screen, I'm also going to attach it to this video. So once we have these accounts set up, we're going to take a look at that spreadsheet and we're going to decide what allocation makes the best sense for our business. Using a $100,000 business as an example, under column A, your real revenue range is between 0 and 250,000. So you are automatically going to put 5% of every dollar that comes in outside of taxes. So if you make $100, your customer would pay you $113. $5 of that will go into your profit account. Right off the top, profit first. We are always taking out our profit first. Now the next thing we're going to do is we're going to pay ourselves. Let's say our business is bringing in $100,000 and we want to personally make $50,000 a year as our paycheck. After we have put 5% into our profit account, profit first, we need to pay ourselves. Now, if you are making between $0 and $250,000 as your real revenue range, then your owner's pay should be 50%. So 50% of whatever you bring in should be paying yourself. Always pay yourself first. If you are working and not paying yourself, there is no point in working. $5 of 100 is going into our profit account, and $50 of 100 is going into our owner's pay. Now, $13 is the tax, so we're putting that into our tax account right away because there are two sure things in life, death and taxes. And believe me, the government will always show up for those taxes. So not only do we have to put $13 into our tax account, but that additional 5% that we've allocated as what we need to pay the government. So we're going to put $18 out of that 100, which is actually 113 because you've paid taxes, into your tax account. So what are we up to right now? The 13% is on top of the 100%. So this is 15%. So this would actually become 28%. Although this doesn't matter because the 13% is on top of our revenue. So this is $15, 100 plus $13 for HST. This looks better. So we're ignoring the 13% because that gets charged on top of the $100. We're ignoring the fact that this is 28%. Our tax is 15%. Our tax is $15. Owners pay 50% of that $100 goes into our pocket. Profit is 5%, so $5 goes into the profit account, and what's left over is what we have to run our business. So we're now up to $70 out of $100 for tax, owner's pay, and profit, which leaves us with $30 left for our expenses. And that comes in right on the money. If you're making between $0 and $250,000 a year, your operating expenses should be at 30%. So on $100, that is $30. Now, you're looking at this going, but what if I have more than $30 worth of expenses on that $100? Well, this again goes back to Parkinson's law. You need to take a look at your expenses and start cutting things, because if you are spending more than $30 on 100, you are not a profitable business. You are bleeding money. You need to get a hold of your expenses in order to be profitable and sustainable. And this is the difference between the companies that went under during COVID and the companies that were sustainable. They made sure that they had a profit, and that profit was there to keep that company alive when COVID hit. So what do we do with profit? We are saving 5% of everything off the top, no matter what, into a savings account for profit. Now let's say we make $100 a week for a year. At the end of the year, we'll have $260 in our profit account. Now these are very low numbers. We're pretending that it's $100 that we're making per week, and this is just for the example of this video. So now that we have $260 in our profit account, what can we do with this? Can we take it out and spend it? Well, yes and no. Most business owners, the reaction to this would be, I've got $260 saved up in my profit account. I'm just going to dump it back into the business. And that is incorrect. We are going to divide this by 50%, which gives us $130. This goes into the owner's pocket, or if you have partners, it becomes a profit distribution. If you want to give employees a portion of the profits at Christmas time, it comes out of that money. And the other $130 stays in the profit account. And this is essentially the rainy day account. It stays in the profit account. Every year, 50% goes into profit distribution. Every year, the other 50% stays in the profit account. And the reason it is there is essentially exactly for things like COVID. If you are putting away your profit first and foremost and hanging on to it, then when something like COVID hits or the recession of 2008 hits, you should have 6 months of expenses saved up in that profit account to make sure your business stays alive, to make sure you don't have to let your staff go, to make sure your expenses are covered. And that is why we keep that money. Now, as your business grows, take a look at the chart. Pick where your business sits. Is it 0 to 250K, 250 to 500K, 500 to $1 million, 1 to 5, 5 to 10, 10 to 50? Take a look, pick the spot, and allocate those percentages per the chart. And then again, the very first thing that comes out is profit. Every single dollar profit goes into the profit account. The next thing you are going to do is pay yourself. Above all else, you need to pay yourself. If you're not paying yourself, what is the point of running a business? Third, you're going to take out your tax money, because the tax man is calling no matter what. After you take out your tax money, then you deal with your expenses. Now, if your expenses are too high, you need to cut your expenses. If you use your credit card, your business credit card, to pay for a ton of stuff, and it's going to be a lot of work to figure out what those expenses are because your credit card has been used so much, then what you are going to do is you are going to call your bank and you are going to say to your bank, I need to reissue my credit card and I do not want any pre-authorized payments transferred to the new card. Now, what this is going to do is your bank is going to give you a new credit card and they're not going to transfer any of the pre-authorized payments. So you're essentially starting fresh. Some people might go, but what about all my expenses? Trust me, it's not going to matter because when it comes time for those subscription renewals, those people, those businesses, those companies, they're going to reach out and tell you that they couldn't process your credit card payment. Now, what this does is it allows you to take a bigger picture look at your expenses, and when they come calling that your credit card would not let them take a payment, you can decide at that point, is this an expense that is necessary for my business, or is this something that I don't really need that was an impulse purchase that I can remove? And at that point, you can tell them, here's my new card, or no, we're canceling our service. And this will help you bring down your expenses without having to do all the groundwork ahead of time to figure out what those expenses are. Now, the people that you are paying by check, you'll know at the time that it's time to pay the piper. And at that point, you can either cancel whatever that service is or send the check. But again, these expenses need to be brought down. So 30% if you're making less than 250,000, and that number is going to change as you work your way up the chart to whatever your business revenue is. But again, profit first. This is what is going to get you to your goal owner's pay. Now, when you do this, your accountant is going to get a little confused with all these different bank accounts. I know mine did. So you're going to want to let them know ahead of time that you are doing this. You're going to want to explain it to them so that they understand what's going on here. And they might be confused by it because, again, in accounting, we're taught the traditional method is sales minus expenses equals profit. Once you explain that to them, they will understand, and then they'll know how to account for this when they're doing your bookkeeping. If you want to learn more on Profit First, I'm going to link to a book called Profit First by Mike Michalowicz. He is a financial advisor. He is the person that created this formula. He is a very well-known author, and he's written a ton of books on not only this, but how to grow your business, how to put processes in place, how to go from entrepreneur to $10 million company. Very, very knowledgeable. I highly recommend checking out the books. I hope you found this video useful. Let us know in the comments down below if you enjoyed the video. Let us know if you're trying this Profit First method. Let us know how it turns out. If you have any questions, leave us a comment down below. Like and follow us on Facebook and Instagram. Subscribe to our YouTube channel. We'll see you in the next video. Cheers.